to me, mortgages are my passion. It's my business. We spend 9-10 hours a day talking about mortgages, doing mortgages, putting out those flyers, closing deals. And what I'm a firm believer in is these 3 pillars to wellness. There's mental, physical, spiritual, and everything falls in there. And like the biggest game changer for me was implementing a morning routine that was in alignment with that, right? Okay. So for me, and I think it might be related to the space, but like in the past, I used to tend to be running high on anxiety or stress, right? And how could you not be? You know what this game's about, right? When that was a present feeling, other areas of my life took a hit, right? And so it was about the first thing that I'll do now when I wake up is get my head into the right space.
Hello, everyone. Welcome to Keys to Success with Andres Garcia, the podcast where we unlock the strategies to thrive in real estate and to thrive in business overall. I'm your host, Andres Garcia, and each week we'll dive into proven principles and insider tips that have helped industry leaders build their businesses as well as become successful. Today, I'm here with Josh. He is one of my preferred lenders here in Florida, top of the notch in mortgage. So welcome.
Thank you for having me, Andres. Happy to be here, man.
So, we'll dive into a lot of subjects. We have a lot to touch in today. We got, recent news yesterday of the Fed cutting rates. So how do you feel about that?
Yeah, man, super exciting. And I'm glad you brought it up because there's so much we can dive into here, right? But I think the first thing I want to point out is Fed discount rate does not equal mortgage rates. And a lot of people see that movement. Yeah. And they're like, mortgages came down by 50 bips, right? Yes, it influences mortgage rates, right? But mortgages function like stocks. There's a secondary market for mortgages, right? I'm sure you bought with a mortgage and a couple weeks later, hey, your loan's been sold, right? There's a secondary market. So just like stocks, a lot of the pricing with mortgages is speculative. It's based on market sentiment. So when we get good news, Fed discount rate lowering is good news. CPI getting better is good news. Inflation improving is good news. Job reports, stuff like this. When we get good news, the market feels better and inherently mortgage rates will lower. So the knock-on effect, right? My take on yesterday's Fed decision, first rate cut in 4 years. That's huge, right? It gives a lot of strong positivity to the overall market. How it will affect mortgage rates, right? The reality is a lot of that was baked in. Months ago, the Fed announced that they're going to cut rates, and they announced at this meeting on this date, we'll be doing a rate cut. The day they announced that, mortgage rates plummeted. Pricing improved. Yeah. Right.
So that's what we were seeing lower rates a month ago, for say, or like a month and a half ago.
Exactly. A month ago, you start seeing all the news, hey, mortgage rates at the lowest point in 18 months, whatever it was, right? And so that was the initial boost. Now, my take on it is everyone kind of expected a 25 basis point reduction, right? And so let's equate it again to stocks. You like Apple. Apple comes out and says, hey, our earnings are going to be great this quarter. And a couple stock analysts upgrade the stock and the price goes up even before earnings come out. Now, if people were expecting earnings to be here and Apple comes in here, that's already priced in, right? But if Apple comes in a little higher, now the stock's going to improve a bunch, right? And so that's my take on yesterday's meeting, right? I think the greater market was expecting 25 bips. We see a 50 basis point rate cut. Maybe not instantly, right? But that's good news. It's better than expected. So I think over the next weeks and months, you'll see continued reduction in rates.
So where do you think that the rates are going to be for the next three to 4 months until, let's say the end of the year? Do you think that rates will continue to lower? So I think right now we are, right at 6%, give or take?
Yeah, depending on the lender, depending on the premium, the product. But 6 is a healthy number to use for reference. I think for the rest of the year, again, I am an optimistic guy, but I do think you'll see continued pullback. I don't think you're going to see huge free fall like you did when the announcement was first made months ago, right? Now everyone's expecting more rate cuts before the end of the year. So again, think of the stock market. That should be priced in, but you'll probably still see some pullback and some improvement.
Okay. Not bad at all. So what are you recommending your buyers to do? Because we as agents, I mean, the first thing that I do is I incentivize buyers to really look at the market now and look at overall what they can do in regards to price of their property, right?
Right.
How much competition there really is in the market. You know, when rates were super high, obviously the competition was very low. Properties were staying or still in the market for a couple months.
Right.
You know, low end you're seeing 30 days, higher end you're seeing 60 to 90 days on the market, right?
100%.
So when rates do come down, obviously there's more buyers that are going to be able to qualify. There's going to be more competition, which at the end of the day should, based on economics, drive the price up, right?
100%.
So even though your mortgage might have a lower rate, you got to look into the price. So as my personal opinion, right now could be a great time to buy, right? Because we're still looking to, you know, lower rates than we had, you know, 3, 4, 5, 6 months ago, but they're maybe not as low as they will be in the next 2 to 3 months.
Right.
And you know, maybe a lot of buyers are still waiting on the sidelines. I don't know what's your vision and what are you seeing in your business?
Well, look, it's a great point. Let me backtrack. I know you've seen that graph that's going around about buyer's market versus seller market, right? And the chart, and you could see 2018, 2019, 2020, 2021, 22 even, strong seller's market, right? And we saw, at least here in Miami, $400,000, $500,000 condos with 30 offers on them, right? And nobody could get under contract because everybody qualifies at a 2.5% interest rate,
For sure.
right? As those rates went up, it started turning into a buyer's market. And I know now the graph is showing it's moving closer to a more balanced market. As rates come down, it's just economics, right? Prices will go up.
Yeah.
As a mortgage guy, and I'm sure you've heard the phrase, we always say, marry the home, date the rate.
Yeah.
Right? You're always going to be able to refinance, but I like to lead by example. I bought during a rate spike. You know, I bought about 2 years ago. Rates were on the way up. They're higher than they were today, actually. To me, it's a win. You know, I'll give you a real example why. In 21, in 22, you probably saw a lot of your deals weren't appraising.
Correct.
Or at least that's what I saw, right? And so let's use an example of a $500,000 home. Are you better getting into a $500,000 home or a $500,000 price point when the home is only worth $420 because you have a 2.5% interest rate? Or are you better paying a $500,000 price point in a home that's worth $580 at a 7% interest rate? Me, I look at deals for equity, right? I would rather buy into positive equity. I know rates are going to go up and down, and I know there'll be the chance to refinance, right? And so, for sure, I think the advantage that buyers have had these last 2-3 years is slimming, and I think it's going to continue to slim. And, you know, as long as rates continue to come down, which everybody's predicting, you're going to see more people qualify. You're going to see a shift again into a seller's market, especially with a lot of the programs here in Florida with down payment assistance, with Hometown Heroes, with...
So I was going to touch up on that. So I believe it was yesterday you posted something on your social media about first-time homebuyer assistance, grants. So can you talk a little bit about that?
The one from yesterday it's actually my favorite program right now, and I'll tell you why. A lot of first-time homebuyer programs are based on income levels, especially with down payment assistance, right? You want down payment assistance, you cannot earn more than X amount, or typically what's called AMI, area median income.
Okay.
We have a really awesome program right now that doesn't measure income levels, right? You can make 50 grand a year, you can make 500 grand a year.
Okay.
It's purely based on the area that you currently live versus the area you're moving into.
Okay.
Right? I'm seeing in Miami-Dade to Miami-Dade, Broward to Broward, Miami to Broward, I've been seeing about 80-90% approval rate for that program. Again, it's based on your current address and the county you're moving into.
So does it have to be with moving into a higher income area, lower income area? Are there any metrics on that, or?
They consider them lower income areas, right? And there's a lot of beautiful things here and a lot of flash in Miami, in Brickell, in downtown, right? But the broader part of Miami-Dade isn't necessarily representative of that, right? So we've seen a lot of approvals with that for first-time home buyers. And, you know, like I said, very well qualified first-time home buyers that really typically would not get that down payment assistance. And that program's super cool because there's so many layers to it, right? There's the down payment assistance. That's not a grant. It's not a loan. It's a credit, $5,250, right? On top of that, most deals need an appraisal. If you're coming with 20% down, sometimes we can work a way around appraisal, and we do that well. But you're getting a credit for another $500 towards the appraisal, which covers most of it. Outside of that, if you have less than 20% down, you need mortgage insurance. It is very, very, very discounted mortgage insurance, like 50% of what it should be.
Wow.
Which is huge, especially if you're looking to, qualify at the higher end of your range. That can be a deal maker or breaker for people. The biggest thing is the access to the rates that you'll have, right? And I'm going to get a little technical here. I hope that's okay.
Yeah.
But
go ahead.
How rates work, right? There's this idea of the rates that are set at the Fannie Mae, Freddie Mac level. And then there's this idea of an LLPA. Or
what is that?
A loan level pricing adjustment.
Okay.
Right? And so what's an example of an LLPA? Let's just use totally arbitrary numbers for this example. Let's say the prime rate, if you're coming with 20% down, if you have an 800 credit score, you have great debt to income ratios, let's just say the prime rate's a 6%.
Okay.
Right? Now, that will be used as a base, right? But as you deviate from those prime characteristics, now you're not at an 800 credit score, you're at a 740. There will be a pricing adjustment, right? If a 6% was par, or you're not paying any origination points for that rate, now you're at a 740, not an 800, that 6% might cost a quarter of a point or a half a point, right? Increase your closing costs. That differential is what's called an LLPA, or a loan level pricing adjustment. And they come straight from the government agencies, Fannie and Freddie, right? Fannie says, hey, at this credit score, we're adding this much, in points to your rate. Or the other, right? If you're better qualified, we're reducing it. So the idea there is there's two types of LLPAs. There's from the government agency level, and then there's from the investor level, right? You're going to Rocket, you're going to PennyMac, you're going to Loan Depot, whoever it is, right? Whoever's underwriting will typically add their own LLPAs as well, right? There's margins. People need to make money as well as they need to curb their risk, right? So the beauty behind this program is there's zero investor level LLPAs, right? What's an example of an investor level LLPA? You buy a single family or you buy a condo, the same scenario, you're going to pay 3/4 of a point more for the condo, right? Not 0.75% higher, but on a $1 million loan, that same rate's going to cost you another $7,500.
Crazy.
With this program, there's no LLPA there.
Okay.
You're paying the same for a condo as you would for a single family home, right? So when you stack the credit factors in there, the DTI factors in there, the LTV factors in there, the property type factors in there, multifam versus single fam, for example, all those LLPAs add up and get really, really significant. And when you're qualified for this program, you don't have those. So we've, nature of the market, we compete. And I like to say we're the most competitive, but I've had estimates come to me where they're a first-time home buyer and they just don't have this program in.
Of course.
And we're saving clients $10,000, $15,000, $20,000 on closing costs, depending on the loan amount, right? Yeah. So it's a huge advantage. And again, it is something that's not income dependent. So
yeah, and really a lot of people don't know about that because it used to be, and correct me if I'm wrong, but a lot of these grants that the government was giving out before, first, a lot of people didn't know about them, or they knew, but they didn't know about, like you said, it had to be a certain credit score. You had to be a certain income. It had to be a certain area. So
for sure,
you needed to be in specific areas, price points, and have a, whatever credit score it was to be able or eligible for that grant. So what you're saying now is that there are different types of programs that buyers can tap into to, get that assistance.
For sure.
And
way easier to qualify with.
Which I think it's great because, at the end of the day, especially buyers now, I think they're going to, have some, not issues, but I think that they're going to find themselves really diving into their financials to buy a home, right? Because now you have what we are talking about in terms of buyers agent compensation as well, right?
Well, yeah.
So I haven't seen it as much, to be honest. I think agents have been surprisingly good at keeping the real estate market as it was before,
Yeah.
where the seller still offers some type of compensation, because we as agents understand that the 80% of transactions happen broker to broker, right? If you take 80% out of your reach, like if you take 80% of your marketing out, you're only really targeting 20%. You're losing 80% of the market just by not offering it any type of compensation.
Right.
So I think, sellers still understand that, but the people, that 20% that don't, and the buyers will have to pay for their agent, that's going to be another 2-3% that, they're going to have to come,
For sure.
out of pocket.
Well,
So that's really going to affect some buyers in regards to, okay, now with that grant, we could cover that cost, right? For example.
well, that's exactly it. And outside of, I mean, a related question that I actually have for you is that 20%, where their sellers aren't offering compensation. What do you think that does to the days on market, realistically? Like, do you think they're going to get their property sold as quickly or under contract as quickly?
I don't think so, unless they're really pricing their property
Right.
right.
It would have
correct?
to be priced in. It would have to be 2
So
or 3% lower,
It's
right?
a wash off. Yeah,
Yeah.
it's a wash off for the seller, in my opinion. Basically, we're accustomed to that, market where the 6% or 5% or whatever the negotiated commission is, it's already put into the deal, right? It's already put into that $1 million property asking price, right? Now, if you
That's
only
exactly
offering
right.
3%, right? Well, again, the buyer has to come up with the remaining 2.5 or 3% commission that the agent usually would get, right? So the buyer is going to say, okay, well, I'm only going to offer you 97% of your
Yeah.
asking price, right? So
Seems logical.
at the end of the day, it's going to be the same. So I think it's a matter of whether the seller understands that concept, how flexible they are on their financing in regards to, okay, when they bought the property, how much equity they have, right?
Right.
But I think that if they expect just to get more money, we are seeing properties sitting on the market for 6 months, a year now, and they're just
Crazy.
staying there. We're seeing properties, reducing prices. Like, I was just with a client. I was talking to a buyer of mine, the seller of the property that we're going to look at later this afternoon. They started at $1.2 million about a year and a half ago,
It's been on the market for a year and a half.
on and off.
Okay.
Now they have it listed at $975.
Right.
So you see the difference in pricing, right? It's almost 250K
For sure.
that you're seeing right there, just because you didn't listen to the agent, or
You didn't price it appropriately.
you didn't price it accordingly. Correct.
I don't feel
So-
the market has come down a lot in Miami-Dade. I just think it's continued to appreciate. I believe the statistics might support that.
In certain areas, yes. In certain price points, yes. I do think that condos are suffering a little bit,
yeah.
because of the whole issue with insurances and taxes as well.
And the new legislation, right?
So a lot of condominiums are getting hit with huge assessments, which I know a lot of clients, they're kind of forced to sell because they were paying $2,000 a month.
Now they have a $2,000 a month extra assessment for the next 20 years.
Exactly. Yeah. They're getting hit with $600 a month more, $1,000, depending on the building and what
Right.
they need to do. Because now they also have to put into reserves, right? Each condominium has to put money into reserves. So that cush has to be covered by the homeowners.
Of course.
Insurances, if the condominium is older than 20 years, I mean,
Through the roof.
through the roof. Crazy. So, all these people are getting really hit by a lot of angles that at the end of the day, if you were to buy also, you're going to look into that. And just because of how much money you're going to have to pay monthly, again, the price has to reflect that, right? So prices
100%.
will come down to adjust to meet that medium. So I think the condominium is an interesting market right now. There's a lot of opportunity for people that want good deals, I think.
Yeah.
But then also we're going to see a lot of new construction condominiums, which you're not going to have that issue because, again, new construction is going to be to a new code, right? It's going to be built into the new code. You're going to have impact
sure.
windows. Insurance is going to be lower. You're already going to have your reserves already put into.
Right.
So
So,
they're gonna
those buildings probably won't be taking the hit that maybe the broader condo market might take here in Miami.
Exactly.
Got it.
Exactly. But then the single family house market, I think it's where really everything's shifting towards, right? Because a lot of people are, looking, okay, so can I just buy a single family house? We saw that a lot in, through COVID, more people wanted a little
Everyone
bit more
wanted a single family.
space, wanted a pool,
Right.
wanted a backyard. So
Privacy.
privacy.
A
So,
lot of a lot of benefits.
a lot of people move towards that sector. So I think that the market in that area is still pretty steady.
Yeah.
I haven't seen a huge change. I think that a lot of people wanted to make money if they bought through COVID when prices went up so quickly. If you're looking to make money right now, like 15-20% on what you bought it for, that's not going to happen. But I think that right now you could probably be still breaking even to where, if you bought it 2 years ago or a year and a half ago.
Right.
Um,
Right.
So,
It's a valuable insight.
mhm.
But, back to that example, just curious, that example, you said it was 1.2, now it's 975. That was a single family home. So in that case, probably
They're
just
losing
not
money.
not listed properly, right?
Yeah, or they didn't buy it properly. I mean, you have to. So through COVID, there were really weird scenarios where people. I mean, there was a lot of cash laying around, right? You got all the incentives,
Right.
all the money, PPP that we're giving out.
Yeah.
So people had money to buy, and a lot of people bought properties. So
And they're willing to pay over appraisal, like we
Exactly.
spoke about, right?
so people were like, I want that house, I like it, I'm willing to go 100K over asking,
yeah.
no contingencies,
Right.
all cash because I can afford to pay over the appraisal, like you said.
Right.
So appraisal came in at 1 million, and they paid 1.1, 1.15, 1.2, whatever it was. Then yeah, you spend 1.2 on the property,
Right.
but the property was only worth 1.1, right?
Right.
So now it's selling, at the price that it should have been sold.
Right. Or you got to wait it out.
Or you gotta wait it out. So it's a matter of really what the specific situation. I think that there's a little bit of everything going around, just because COVID was so unprecedented and it wasn't something that a lot of people have seen before.
I don't think anybody was prepared for that.
I don't think so either. And
Even-
I think we're seeing the consequences now of that, to where, like, okay, I mean, obviously the market was a little bit of everything, through this couple year and a half.
For sure. Seen the highs and the lows.
And now we're finally stabilizing, right? We're finally seeing, okay, rates are somewhere comfortable where people can
Yeah.
afford again.
Yeah.
Sellers are being more reasonable about their sales price. So, that's why I think right now it's a very, very good market for both ends at the end of the day. Seller and buyer, especially if you have to sell and buy. I think that
It's way more balanced, for sure.
you can get a good price for your home, and you can still negotiate a good price when you buy it.
And I think, to be candid, there's been this inventory crisis, right? The last couple of years. I think a lot of that was driven by the rates as well, right? You have people who 3-4 years ago were qualified to buy a $900,000 home, and the payment was super comfortable. And, now even if they have equity, right, and they make $100,000, $200,000 out of that, they roll it into the next home. Congrats, you're qualified for a $600,000 home. And by the way, your payment's almost double what it was before, right? And so there's like, why would we sell right now? So I think
Sure.
this market stabilization is going to be really great news.
Yep.
Buyers and sellers.
Correct.
So,
100%.
yeah.
So, we've talked a lot about the market and what we're seeing, the expectation for the next 3 to 5 months. I think next year, we're going to see a lot of, again, kind of seeing the market getting more normalized.
Right.
But I wanted to ask you, okay, how much do you think it could benefit a buyer to buy right now or wait after, the new year, so 2025? Do you think that they should wait just as a mortgage standpoint, or they should, go ahead and lock in right now?
Look, and again, I want to make it clear, for sure this is an opinion, right? But
Of course.
I look at it as an educated opinion. It's something where we're in the nitty gritty day after day. It's, not a hobby. That being said, I like now more. And I'll tell you why. Like, as we predict, if rates come down, prices go up, more competition. Already there's competition here in Miami. Even with rates going up, with everything, aside,
Yep.
when something's appropriately listed, it's selling quickly. That's my standpoint. And I've seen a lot of my clients even in the last year, competing against multiple offers.
Mm-hmm.
You know, I have a deal right now that was off market, went under contract for 600K, and you know there was a strange appraisal issue. Regardless, when we were working to negotiate, they're like, dude, we got 4 other cash offers at asking price, so like buy it or kick rocks, right?
Yeah.
And so I think as rates come down, you're going to see more of that.
Okay.
And as rates come down, there's always that opportunity to refinance, right?
Yeah.
If it comes to like, hey, I know rates are coming down, but right now where rates are, I don't like that payment. There's always these really cool tools like the temporary buy down products, right?
Okay.
Right now, you can get, you know, you want to pay a little bit of an origination, you can get a conventional loan in the high 5s, right? Potentially even lower. Now let's add in a 2-1 buy down or a 3-2-1 buy down. That means your first year you could be in the high 3s or even the high 2s, right?
Yeah.
And so whether rates go there again or not is, you know, a totally different discussion. But
sure.
as rates come down, if you can get into a comfortable payment today,
Mm-hmm.
and you know you're going to appreciate as rates come down, I think that's an infinitely better move. You refinance then
Yep.
and get into something for the long haul. That's my take on it.
Okay. No, I can respect that. And I think that now is always the best time for anything. You don't know what the future is going to hold.
100%.
So you know what now is. You don't know what 2-3 months, you know, I mean, everything can change in a month, in a day.
Yeah.
Right. That's just a personal opinion, right? You're seeing something. There's a lot of times where, you know, for example, clear example was COVID, right? There were a lot of people that when COVID started happening, they got scared and they, you know, fire sold their house. So they were like, oh, this is going to crash everything. Like, you know, we don't know what's going to happen. And literally 2 months later, the market just completely went up. And, you know, properties got, you know, 20% more on appreciation over a year. I mean, I know clients that made 200-300K in a year just on appreciation alone. You know, there's a lot of uncertainty on what could happen next year, especially with a year where you have elections. There's
Right.
a lot of policy going on. There's a lot of, you know, we want to do this, we want to do that.
There's a lot of uncertainty too, right?
So you never know what could happen next year. And like you said, you always have an option to refi in the event that, you know, rates do come lower. And correct me if I'm wrong, but let's say you start looking at a property now, right?
Right.
And you get locked in at a 6%.
Right.
But then you don't buy something for a month and a half or 2 months, right? And lowers then do come down, right? Or through the process, let's say you get under contract, but the contract only closes in 2 months. It's a longer closing
Right.
for some reason. Are you able to get the lower
Very
lower
good
rate
question.
at that point? Like, you know, let's say that rates do come down in a month and a half.
Very good
What
question.
happens then?
So there's like always a two-pronged approach there, right?
Okay.
Most lenders, direct retail lenders, big lenders have this idea of like floating down your rate, where even if you're locked right now, if there's a big market shift, they'll float it down. I've honestly never seen it happen. I'm not saying it doesn't happen. I've never seen it happen.
Okay.
Right. That being said, one of the benefits to the model that we put together at Olympus Financial, both wholesale and correspondent, if we're funding it ourselves, we have more than 80 different investors, right? And so like we don't like to burn locks. That's never the idea. But if we were to lock someone in and there's a 90-day contract, and over those 90 days, there's a huge reduction in rates, where at a lot of lenders, you're like, okay, you're already locked. Like, too bad. We have the ability to just simply switch investors, relock at market with a new investor, and transfer the whole file over, right?
Okay.
So,
But you wouldn't have to do another appraisal. You wouldn't have to
Exactly.
do anything. You just
None of
transfer
that.
everything.
none of that, especially when it's on the correspondent level where we're lending directly.
Okay.
It's our file now. We choose where we want to, source the funds that are going to buy the loan from us. But at the end of the day, if we want to move our lock over elsewhere, we can do that.
So you're touching up on Olympus, and one of the reasons that I created this podcast was to obviously educate people and talk about what I do on a daily basis, which is real estate, which is investing, which is just really creating wealth through real estate, but also to create a spotlight in local businesses. And you are not only a loan officer, but you created your own business, which is Olympus, right?
Right.
So can you walk me through a little bit what your career has been, where you
Yeah, man.
started and, all the way take it up to now that you own your own company?
Yeah, for sure. How long do we got?
Yeah. No, I
But
don't know. Go ahead. Go ahead.
look, it's life is such a cool journey, how things change and how we grow. And I came out of school more than 10 years ago now.
Okay.
I had a degree in business and in technology, and I went and worked for big corporate. I was at IBM for 5, 6 years,
Okay.
and like had this whole vision of that's what I wanted, right? And we change and we grow. And what I realized is I'm a self-starter. I'm a hungry guy. I'm a hustler. And what I noticed on that corporate route, at least for me, was it got to a point where the compensation and the fulfillment just didn't match the effort, right? And I was outperforming my peers, and instead of being rewarded, my quotas were getting set higher.
Yeah.
Or, I almost felt penalized. And I realized the only way to get to where I want to get to is with time, right? I'm going to have to give this company 20, 30 years of my life. And, I'd seen heinous things happen to people that have done that, getting fired right before they resign, whatever it is, right? And so somehow I stumbled into the mortgage space. I had always wanted to be in real estate. My mom is a realtor for more than 30 years.
Okay.
I always had this fascination with real estate, but I also have this technical inclination. And somehow stumbled into the mortgage space. It started on the side as a loan officer with a retail lender. Almost instantly, found my passion there. Started picking up traction, started building business. Not only am I fulfilled with this business and feel like I'm making a positive difference, right? My parents are immigrants.
Okay.
They moved to this country. Part of that American dream is homeownership, right? So I got great fulfillment out of that. But outside of that, my income levels are almost the same on the side hustle at the time as it was in corporate. And the limit is the sky, right?
Yeah.
The more I perform, the more I make. There's no question. The more I can help people. And so, one day I was just like, dude, in order for me to really take off here and do what I envision, I got to get away from the salary. I got to get away from the safety net. I got to put 100% of my time. And I left IBM, started just as a loan officer, and things moved really quickly, which I'm grateful for. I was super fortunate to have some really heavy hitting mentors, originators doing hundreds of millions a year in production, which is rare. Those are top 1% originators. And the unanimous advice from all the big guys was, Josh, refinances are easy. They're awesome. Take it when you can. Do not go sit in a call center. Do not take inbound leads. Work on building relationships. Work on learning how to close purchase business, how to close tricky purchase business, and add value to people who are active in the market. And then no matter where rates go, when you become that problem solver, you've added value. You're going to be, consistently busy. And that was really the model we stuck to. Ended up moving to Miami.
When did you move?
I moved in 2016.
Okay.
And Chicago's a very different market, right? Yeah. Lots of traditional employment in Chicago. Miami, not the case, right? Lots of self-employment, lots of foreign national buyers, lots of non-warrantable buildings, deals that are very tricky to get done. 9 out of 10 retail lenders don't do them, or they'll say, yeah, we broker them. But when you're at a retail lender, they're incentivized to use their own funds. They make more money there than brokering, right? So a lot of times they don't have the same skill sets or what I see processing power to do those tricky loans. They don't necessarily know that aspect. Eventually found a lot more success by moving into the brokering space and the wholesale space here with a local brokerage in Miami that had the processing know-how, that had the experience. And as soon as I flipped there, like the 20, 30, 40% of the deals that I was referring out to those types of guys, we were taking in.
Okay.
Right. Our volume was increasing. And I was also a unique guy because now we're talking 2019, 2020. Rates are coming down. Everyone's sitting in a call center, leads coming in. Every LO is making money. We were doing what was hard work. Right? We weren't taking leads. We were building relationships and finding success there. And as the only guy in the office that I was at who was a self-generated business guy, I really found my lane and was given the opportunity to start building a team under me, which was awesome. It was something I always wanted to do. Eventually got to enough volume that started getting noticed by other players in the mortgage space and was offered a branch opportunity. And, a branch is running your own P&O. We moved over, we started a branch, then turned into a federal branch for a federal bank, which was awesome. But I noticed like half of our deals were still being brokered. And I'm like, dude, if I'm going to keep doing these tricky deals that I can't even do at the bank, I'd rather do it myself. You know, I don't want to ask for permission from people to help put my clients in homes, stuff that I know I can do. And that's really how Olympus started. I always say Olympus is an organization built by LOs for LOs. Okay. Right? You mentioned I'm still in LO. I'm still one of the higher producers in the company. And really, there was a selfish aspect starting Olympus. It was like, how do I do more deals with less stress? Yeah. How do I put more time on my hands? How do I enjoy my life more? And that was really our mission statement. So we were able to bring over, you know, in my mind, the absolute best processors in the industry that know not just the easy deals, but the tricky deals. Yeah. We pay our processors in a manner that very few, if any, shops pay them, right? Okay. Especially over the last 2-3 years. Very traditional that processors are put on like $20-$30 an hour, whatever it is. Their incentives aren't the same. Mm-hmm. When you guarantee your processors big income, they're not afraid to work outside of banking hours, right? Sure. And all of that adds into quicker turn times, more client satisfaction, more satisfaction with our referral partners, and more volume, right?
So for an LO loan officer that, you know, is where you were a couple of years ago and is thinking about, okay, creating their own company, right? Their own brokerage. How do they go about that? How did you start your own company? What can they do, or what do they have to do to, you know, kind of branch out by themselves and build their own team?
Look, it's a really good question, and it might sound corny, right? But for me, it really is true. The first thing you got to do is believe in the vision. Yeah. Like once you believe in yourself, I find that the rest kind of falls into place. Mm-hmm. To me, the best method doing that, right, is if you're already in the business where it's more referral based, 9 times out of 10, your referral partners aren't with you because of the bank you're at. They're with you because of your skill set and what you bring to the table. Now you interface with their clients. And so, you know, having those conversations preemptively with your core referral partners, with your group, hey, this is really where I see my vision going. This is why I think I'll be able to add more value. We'll be able to get work done on the weekends, whatever it might be, getting everyone in line with you. And then it's as simple as executing, right? Like it's a scary jump, but once you've had the time in the market, you apply for the broker's license.
That's what I was going to say, but you do need a separate license.
Oh, for sure.
Okay.
As an LO, you need a personal license to originate. Okay. As a company, now you need a company license. And there are requirements. You need to have a certain amount of time and experience in the industry as a loan officer. For sure. You need to get the company licensed. Every state is different. And, you know, like I said, I think the big thing is really identifying your vision first, right? Mm-hmm. But the licensing, if you have the time and the financial means to do it, you'll be able to get it, right? Okay. And you can start as a broker without huge financial means. The one word of advice is make sure you're bringing the right team with you, right? Yeah. You do not want to start your own shop and now you're reliant on poor processing or you don't, then you're in trouble.
Bringing in the right talent, always. Right. Yeah. Right. For sure. You know, something that you touched on that I found for my business and my career to be true is getting involved with the right mentors when you start. I think it's huge, just because myself, for example, I was in the finance path, right? In the financial advising. And then, but I was always in sales. I was actually a rep at Louis Vuitton out of college. And all my clients were like, you would do great in real estate, right? But it wasn't until I found the right mentor back in DC 100%. That really showed me, okay, this is what's possible through hard work, through, you know, let me teach you. And if you do these things, you're guaranteed to succeed. And it was true. I mean, at the end of the day, you know, he has a very, very successful team because he's able to show the right path, not only by him doing it.
Keys to success, man.
Exactly. There you go. That's the name. But you really got to get under someone to really learn the business and then jump. I think that a lot of people try to do it themselves too quickly, in my opinion. Yeah. Instead of really just, you know, giving part of your income to someone that will really teach you, will allow you to learn way faster, learn from their mistakes, right? And create your own business to a point on, okay, 2, 3, 4 years. If you do want to go that route and create your own business and go by yourself, now you know, because you've done it, right?
100%, man.
That's key for someone. Take your time to really learn the business, make sure that's what you want to do. Because when you start your own company, it's not just you now, but it's like you said, you're hiring people. So now you're responsible for payroll. You're responsible for other people's lives, right?
Totally new element.
Yeah. So there's a lot of stress that comes with that, obviously. There's a lot of freedom that comes with that down the road. But, you got to make sure that you know the ins and outs of that. I always, say that if you're diving into something, dive in, full on, like full time.
Yeah.
Right?
You can't just put your toe in the water.
Correct.
You're never going to find success there.
Yeah.
So
exactly. But no, that's great, man. Anything else that you wanted to touch in regards to rates, your company, anything else that you wanted to tell the audience?
There was one thing that I was actually thinking of, and it's funny you brought up mentors, right? Because I heard this from one of the many mentors that I've been blessed enough to have over my career. And I still have mentors, right? In many areas, not just in the mortgage space, but in the mental space, in the physical space, in the spiritual space, right? It's stuff that interests me. But one thing I was told, like when I started, is like, how do you deal when people are so focused on rate and rate shopping? And the reality is, let's call rates what they are. It's an arbitrary number, right? Why do I say that? If your goal is to make a payment of $4,000 a month or less on your PITIA, or principal, interest, taxes, insurance, association, total housing expense, what does it matter if the rate's at a 2% or a 7%? If you're getting into something that you're comfortable paying in a home that you love, that should be the focus. So like the big thing for me is always focus on affordability. Rates are always going to go up and down. You might always have the chance to lower that payment, right? But don't miss those opportunities because the news tells you rates are at a high, right? So I think that it's about educating our clients on the realities of stuff, right? Who said rates are high? Fox News said rates are high. I'm not discrediting anyone, but like, well, it's arbitrary. Yeah. You're gonna miss out on a home that you love at a payment that you can afford because there's a random number that you don't like.
I think the key to that is always talk to an expert, talk to a real estate broker, talk to your loan officer first. And get pre-qualified, right? Understand how your finances, what's your DTI, debt to income, how much you can afford on a monthly basis, right?
Right.
And then, okay, am I able to buy that where I want to, or do I have to wait? So if you're able to talk to a loan officer and, like you said, tell them, look, I can afford, or he tells you, look, you should honestly be looking at a $4,000 per month payment.
Right.
But then you tell him, look, I only want to do $3,500. He's going to be like, okay, great, we can definitely do that. Then you go back to your agent, tell him that this is the price point, this is the monthly payment that I can do. He'll put you on a search, and then you can see, okay, there are stuff that I like, at that price point, or there's stuff that, definitely I don't see. And then you just keep looking until you do find the right property, right? But you're never going to know whether, what that price point is and what that monthly payment would look like at that price point until you get yourself pre-qualified and talking to a lender.
Couldn't have said it better. Yeah. Right? And that's why I always say you probably see it on the agent end. Let's just be honest. Lending isn't necessarily sexy. People want to go look at homes. That's sexy, right? I love how the home looks. Yeah. It's exciting. It's working with a lender can be like an audit, man. We're pulling uncomfortable papers. We're looking at your income. We're looking at your credit. We're asking those questions that make people uncomfortable. And it's not because we want to make you uncomfortable. It's because we want to put you in the right position. Yeah. As long as we're doing our job correctly. And so...
And that brings up a great question for you, actually. So if you are working with a buyer,
right?
Okay, what are your suggestions to that buyer? Let's say that their income's good, but let's say their credit is not great, right? What are your suggestions to a buyer to bring their credit up, or can they buy with a lower credit score? Should they wait to really bring the credit score up to be able to afford or buy into better rates, right? And what effect does that have?
That's a great question. Credit is one of the biggest factors on your rates. Let's go back to LLPAs. Mm-hmm. Credit score might be one of the largest LLPAs that you'll see regarding rate. That being said, the right lenders, good lenders will understand these concepts of how to repair credit, how to bring it up quickly, We have tools like a rapid rescore, where
What's that?
a rapid rescore is essentially, let's just say we have a client who comes in at a 685 credit score, 700 being the magic number, right? He's still qualified, but he's getting a way better deal at 700.
Okay.
And so I've now bought the credit report for them. I can actually simulate with my credit agency, hey, can I get these guys to 700? What would that entail? And it runs very, very accurate simulation and say, okay, you know, the credit bureaus are weird. A lot of people are like, let me pay off all my debt. Don't do that. Don't do that.
Okay.
Speak to your lender first, right?
Yeah.
The reason is I'll run the simulation and say, okay, this guy owes Amex $1,200. He owes Citibank $800. Run the simulation to get to a 700. These credit bureaus are weird what they like. They might say, hey, we want to see your Amex balance at $287.12. We want to see your Citibank balance at $127.18, right? And then if you do that in this time frame, typically 30 days, but the sooner the better, you have a 97% chance of getting to a 700 or higher, right? And so then we'll provide those instructions, very explicit instructions. Pay down to this balance. Bring me a credit balance letter from the creditor.
Okay.
And now instead of waiting 60, 90 days for these creditors to report into the bureau and your score to update, as a lender, I can pay a fee for a rapid rescore. It's not something the clients pay for. We pay for it. And I'll force the bureaus to reevaluate your credit in 2 business days.
Amazing.
Right? And so very often, I've seen scenarios where it's straight up not just a better rate, but it saved a deal, right?
Of course, 100%.
Because you have to qualify. A good lender, when they're pre-approving you, they're going to put you through automated underwriting systems, DU, LP. I had a real deal, $600,000 purchase. The guy had a high 600s credit score. DU would not approve the deal. We tried everything, bringing more reserves, putting more down, would not approve the deal. My gut was like, if we can get this guy over 700, it's gonna get an approval. And we were able to rescore him. Sure thing, got an approval. 2 days later, we had the new credit, ran it through DU, got approved, got under contract the next day, right? And so that's, again, it's a skill set. It's the barrier to entry in both your industry and my industry is not the highest, right? You need to study, you need to pass an exam. But being able to close a deal and putting your clients in the best position, that's a different story.
I think you just hit it perfectly, and it's being a problem solver, right? Know
100%.
how to really get the deal done, right? There's a lot of loan officers, there's a lot of agents, but there are very few that really can push hard deals through the table and, you know, make it to the finish line.
Yeah.
There's and that's one of the conversations that I always have with anyone that I'm doing business with is, can you get the job done? I don't want someone that, you know, is just going to be, you know, processing a file, but if we hit a problem,
can you fix it?
What's the solution, right? Give me solutions, because low appraisal, right? Someone say, okay, the deal's done. Well, it's not true. You know, there's options. You can always appeal the appraisal, right? You can bring new comps,
right,
and say, hey, actually, I don't agree with that. Can we reassess that appraisal? And a lot of times I've been able to bring an appraisal up by $20,000, $30,000, $40,000.
Yeah, man.
Because they missed one property that they didn't have, or they didn't know of a property that sold, or whatever it was. Can you negotiate, maybe meeting in the middle, right? Can you take out some credits and, you know, put it back into a deal? I mean, there's a lot of things that can be done, and it's just through experience and really getting it and doing it again that you find that. But going back to the credit score, one of the things that a lot of buyers really hesitate when talking to a loan officer is they're going to run my credit and that's going to damage it, right? How much
we hear that a
truth
lot.
there is behind that? You know, what happens if they are shopping loan officers, right? Like, let's say they're talking to 2 different loan officers, or 3, whatever the number is. Can this hurt their credit, and can this, you know, negatively affect the chances of them getting pre-approved for something?
Well, a very good question. And, you know, something I run into almost on the daily, speaking with clients, right? The nature of my business being very referral based is like often clients will come to their realtor here in Miami and like, well, I have a pre-approval from, you name it, big bank. I'm not going to name any banks, but you name the big bank. And the realtor's like, dude, that's a huge federal lender. We're not going to have success there. Trust me, right? You need to meet someone who knows the market, who's going to work on the weekends, who's going to be able to have enough presence in the market that the listing agent's going to see his name and want to accept our deal.
Yeah.
Right. And so then the client comes to us and they're like, well, so-and-so bank just ran my credit and I know it gets hit every time. And like, there's minor truth there, right? If you do a hard inquiry, there's going to be an impact on your credit score. Now, if you're not doing hard inquiries all the time, you should be looking at no more than a couple points, right? You should be able to count it on one hand.
Okay.
That being said, there's federal protections, there's consumer protections straight from the CFPB that allow you the right to shop for fair home financing.
Correct.
Right? And so in the mortgage world, that number is 45 days. There's a lot of like 30, 90, it's 45. You can go online at cfpb.gov. It's explicit, right? If you ran credit 45 days or less ago, you can run inquiries with 1,000 different lenders. And initially, it's going to show your Credit Karma is going to say, new inquiry, new inquiry, new inquiry. After a month or two, the credit bureaus are going to consolidate and they're forced to consider all of those as just one inquiry, right? And that's the right to shop for fair financing. And I believe that's the case in many other industries of credit.
Yep.
Car buying, like I just bought a new car, ran credit with 20 different lenders. Who's going to give me the best deal? It didn't have more than one inquiry at the end of the day, right?
Yeah.
So I think that's important and a great thing to bring up.
You wouldn't see a change right away in their credit, right?
No.
Okay.
No, and that's another good question is people are like, yeah, but I'm at a 702 and like when you pull it, it's going to drop 5 points. It's going to be under 700. No, dude, when I pull it, I'm going to see your score right now. After that, you might drop under, but it's irrelevant, right? We have that credit file, which is good for 90 days. So
okay. Perfect. No. I think that's one of the things, and that's one of the questions that we get the most, right?
Yeah, man.
Okay, don't run my credit, or and I hate to say it, but you could always talk to a loan officer and tell them, look, don't run my credit, but we don't suggest that because there's a lot of hidden things that you may not know of in your credit, student debt or medical bills, whatever it is that maybe you have an auto pay and you forgot about, that will affect your DTI and at the end your qualification. But it could be done. It would be just not a pre-approval, right? It would just be a starting call.
And look, it's not us, but there's a lot of lenders that'll still stamp a pre-approval on that. Mm-hmm. And it's a recipe for disaster for a few reasons, right? Typical objections to running credit is like, oh, I'm improving it, or oh, I just ran it, I don't want another inquiry yet. Yeah. You got to understand, as a lender, we're not just concerned with your score. Loans are based on debt to income ratios. Yeah. We need to see exactly what liabilities are reporting into your credit report, right? And it's not like, oh, I know that I owe Amex 20 grand. No, what is that Amex minimum payment? Correct. Right? What is that reporting into your credit report? Because that's what's factoring into your monthly debt to income ratios. Yep. Outside of that, it's this idea of running it through automated underwriting, right? You can have a great credit score and something on your credit report DU doesn't like, and there's no deal there. Whereas the loan officers that like, hey, you have a 740, it fits guidelines. Like, yeah, just because it fit guidelines does not mean that you can get it done. Right? Sure. The right pre-approval is gone through underwriting. Mm-hmm. Outside of that, the biggest thing that always comes up, so I'm really grateful that you brought this up, is like, most people don't know where their credit is. Credit Karma told me I'm at 805. TransUnion report told me I'm at 750. Lending credit is a different game, right? These can give you good ideas. But lending credit uses a very, very, very particular FICO model that all lenders in the U.S. have to use. Hands down, right? Literally, I can't even say 9 times out of 10. 99 times out of 100, the numbers that clients tell me they see on Credit Karma are different than what we have. Yep. And it could be in either direction, right? But that's why, if anything, it's important to run credit up front, right? Yep. Because we can identify where you are. Also, we have those tools like the rapid rescore. Yep. Right? So it's about, hey, where are you? Can we fix the credit? Can we get you to where you need to be? And if not, right, you're in the same position you would have been in a non-qualified position, but now we can say, okay, let us refer you to one of our credit repair services that we work with, right? And now we know, hey, over the next 3 months, we're going to raise his credit score 50 points, and more than likely, there'll be a much better deal there.
Knowledge is power. Yeah.
Yeah, man.
Knowing what you have to do to get where you want is, the right way to do it.
For sure.
But yeah, so we're coming right to the end. And one thing that I like to ask all my guests is, I believe in habits and routines, right? So I know for a fact, but everyone here doesn't. that you have a morning routine, that you are into fitness, that you are into, being healthy, eating healthy.
Yeah, man.
So how does your morning routine look like? And, how has that affected your life? Either way.
Man, I'm so happy you asked that, right? Because like to me, mortgages are my passion. It's my business. We spend 9, 10 hours a day talking about mortgages, doing mortgages, putting out those fires, closing deals. But that is a small facet of who Josh is, or
Yeah.
on the bigger picture, right? And what I'm a firm believer in is these 3 pillars to wellness. There's mental, physical, spiritual, and everything falls in there. And like the biggest game changer for me was implementing a morning routine that was in alignment with that, right?
Okay.
So for me, and I think it might be related to the space, but like in the past, I used to tend to be running high on anxiety or stress, right? And how could you not be? You know what this game's about,
sure.
right? So it was like when that was a present feeling, other areas of my life took a hit.
Yep.
Right? And so it was about the first thing that I'll do now when I wake up is get my head into the right space. For me, that entails waking up early, beating the sun up is a must for me, and then getting head into the right space. So, for me, that's 10, 15, 20 minutes of meditation, some breath work usually helps get me into this anxiety-free space. You're not going to hear me talk for the first hour of the day. It might be extreme, but at that point, I have the physical come in, right? I take my morning greens, my probiotics, my vitamins, replenish the system on what I lost while I sleep, and then taking my dog out, playing with her, getting her fed, and then it's straight to the gym. And ideally, that's still before sun come up or early enough in the morning that the competition isn't there, right? Going to the gym, getting that physical out of the way. It's a big passion of mine too, fitness. And now I feel like I've accomplished so much and it's only 9 a.m., right? Then I come home and I'm in the business zone. And also the nature of my business, very often I'm working with clients 9, 10, sometimes 11 at night.
Yeah.
So that morning routine is everything. And the days where I'm unable to get it in, I notice a big difference.
For sure.
For sure.
Yeah. You can feel it. You can almost feel guilty if you don't do it. That happens to myself.
Yeah.
And, sometimes when, I speak to my wife and she knows that, I haven't gone to the gym or I haven't worked out during the day, it does have a weight in you, like on you. And then also it does affect your day quite a bit just because, I don't know, for me, for example, it's kind of like, I don't want to say disappointment, but I want to say like it's like you're missing something, right? Like you didn't do something that you usually do.
Yeah.
And that it's, it's the right thing to do.
Subconsciously, you broke a deal that you made yourself, right?
Correct. So, I'm big on that. And then the last question is, how can people find you?
We're easy to find. I like to think we're easy to find, but Instagram, Josh Jankelow, Olympus.financial is the business page. You'll find all my info in the bio there.
Okay.
Our website, olympusfinancial.co.
Amazing.
Right, if you want to circumvent the conversation. But I always say, reach out to us first, right?
Yeah.
And again, as a business owner, it doesn't have to be me. We have a ton of talented LOs. To join my team, you have to have a 5-star review rating. You have to know the space you're in. You have to be reliable. So anybody that you're going to contact at Olympus is going to get the deal done for you.
Awesome. And what states do you work in?
Right now, we're in Florida, Illinois, Texas, Georgia, and Colorado. And we're licensed both broker and correspondent lender. But we have our visions on many more. We're about to be up in California.
Nice.
We're about to be up in Massachusetts, New Hampshire, New York, New Jersey are on my list for the next 3-4 months. So
amazing.
Exciting stuff for sure.
Awesome, Josh. Well, thank you so much for,
Man, thank
being
you,
here
Andres.
with me. I appreciate your time.
Awesome to be here.
And we'll put all your information down below so people can find you. Again, great resources. If you have any questions about, what you can qualify, what you can buy, always talk to your loan officer. Always talk to your real estate agent, either if it's myself, Josh, or you have, yourself, someone that you like to go to. Talk to them, ask the right questions. We usually have great referrals about, people that we've worked before. I have countless stories about, deals that have gone the wrong way because of people working with the wrong people.
Oh, man.
And, it wasn't until we connected them with the right person that knew how to deal with that deal, right? that we were able to get it done. There was one specific time that, we were before the closing date.
Yeah.
And the broker disappeared. The loan officer gave us a denial letter after we actually got a clear to close.
Oh, no.
And, I had told my client that, that was going to be the case because he was just very fishy. But, we were able to connect them, with the right tools, with the right lenders,
Right.
of course, and, get that deal done, as you know. So,
look, I'm glad you brought it up. I know we're coming to an end, but I'd love to leave one little nugget here, if
please.
possible. A lot of people have the wrong idea about referrals in our industry, right? And they're like, oh, he likes to work with him. They're probably sharing money. They're probably... Big no-no, right? There are so many consumer protections. As a realtor, as a lender, it is absolutely never the case. I don't want to say never the case, right? But with legitimate realtors and lenders, you're not getting a kickback. There's no referral fee. You as a realtor are satisfied when your client closes. You know, as a realtor or client who's using finance is only going to close with somebody who can get the deal done. That's your interest. Me, as a lender, when I refer deals out to realtors, right? It's not about, hey, the realtor's going to pay me. They can't. They don't. It's more about, hey, this is the client's needs. I know the agent who's going to take them to the finish line.
Correct.
Right? And we see it all too many times where it's like, no, this guy's random. He's making referrals. I'm going to go with my cousin's, husband who's an agent. Don't do that. Trust your team.
Correct. And you said it perfectly. It's not that you are getting something, more than just the satisfaction of closing that deal and making sure your client is taken care of.
Right.
Any referral that we give out, is not because, like you said, it's a compensation hidden in the back, but it's because we want that relationship to stay intact. We want, whoever we refer to take care of our client.
You want the client to win.
And if it's at the end, a transaction that we are working in, for example, we want the transaction to go through and, obviously the client to be happy because they're the ones who are going to refer myself to their friends, family, and, down the road, they're going to be the ones that give you the business. And that's more payback than any other compensation that anyone can think of. And like you said, It's actually not legal to get compensation from lenders or title companies. So great point. And again, thank you, Josh, for staying here with me.
Awesome.
We'll leave all the information for Josh, myself, how to get in contact with us. If you have any questions, feel free to comment below. As always, make sure to like, make sure to follow. And until the next one. Yes, sir.
Yeah, man.
All right, man.